FHA's mortgage insurance can look harmless at first, just a small monthly fee. But if you put less than 10% down, you can pay it for the entire loan, a full 30 years. That adds up to a lot of money. Here's the deal. Put 10% or more down, and FHA's mortgage insurance, called MIP, can drop after 11 years. Under 10% down, and it never falls off. I'm going to show you simple ways to stop paying MIP or get out fast. You'll see the basic math, the right time to refinance, what equity means, and when FHA still wins. I'll also point out the one timing mistake that keeps people stuck. Okay, so now let's get into it. Why does this matter? The monthly fee may look small, but paying it for many years can cost more than a small change in your interest rate. It affects what home you can afford, when you can sell, and your long-term money plan. For agents, picking the right loan means smoother approvals. Now, what is FHA MIP? It has two parts: an upfront fee you usually add to the loan, and a yearly fee you pay each month. If you put less than 10% down, that monthly fee lasts for the full loan, 30 years if you've amortized it for that long. If you put 10% or more down, it can end after 11 years. So, when does FHA still make sense? When your credit score is lower or your debt is higher and you need easier rules to qualify. FHA is also helpful after recent credit issues, and FHA lets sellers help pay more of your closing costs than many conventional loans. That can help you cover cash at closing. How do you escape? Route 1. Start with FHA and refinance to a conventional loan when you reach 20% equity. Equity is your share of the home. You build it two ways: home prices going up and paying down your loan. Before you refinance, check the rate and costs. Only move if your savings beat the costs in about 24 to 36 months. Get your home ready for the appraisal. Fix obvious items. Know the best comparable sales and have clean paperwork. Route 2. Start with FHA 10% or more down. Then MIP can end after 11 years. Compare using extra cash for a bigger down payment versus buying points to lower your rate. If the seller gives credits, use them to buy down the rate when it cuts your total payments more than adding a little more to the down payment. Route 3. Go conventional on day 1. If your credit and debt to income fit, PMI on conventional can drop at 20% equity. Ask your lender early how their PMI removal works so you know the steps. Here's a quick win. Make a simple 3-option plan. FHA with under 10% down, FHA with 10% or more down, and conventional with 5%. Include the upfront MIP you finance, the monthly MIP or PMI, and how fast you think you'll reach equity. The math never lies. Pick the lowest 5-year cost. Common mistakes: chasing the lowest rate, but ignoring how long MIP lasts. Refinancing too early without enough equity. and forgetting that upfront MIP increases your starting loan amount. The timing trap is refinancing when home values are flat and you can't reach 20% equity. Wait, make smart fixes or prepay to close the gap. Set up your down payment, equity plan, or refi timing to lower your 5-year cost, and you'll escape MIP the smart way. If you're a buyer, let's map your numbers. If you're an agent, partner with me for cleaner approvals. Reach out today at 915-478-1157. I'm happy to help.